The next item of financial statements to go through is the income statement. And the income statement is the statement which shows how much revenue, how much sales during a period, during a 3-month period or 12-month period, you're able to generate in terms of sales, expenses, and profits. So let's watch a quick video by Wall Street Survivor talking about the income statement.
What is an income statement? Presented by WallStreetSurvivor.com. An income statement shows the financial performance of a company for a given time period. It shows a company's revenue and costs and is therefore a pretty good indication of the strength of the company. Income statements are also called profit and loss or P&L statements or revenue and expense statements. Income statements are prepared as a part of a company's financials. All public companies are required to submit them quarterly, regulated by the SEC. So let's look at a simple income statement in practice. Here's Mary. Mary owns her own successful flower shop, Petals, and has begun filing her income statements for the quarter. Last quarter, Mary sold $500,000 worth of flowers. This is her top line revenue. Revenue is also sometimes called sales. Next, Mary needs to add up all the costs directly associated with cultivating her flowers. These costs include things like seeds, earth, fertilizer, and electricity. These are added together and are collectively known as costs of goods sold, or COGS. Revenue minus COGS is known as gross income. Think of this as money made from both growing and selling flowers. After that, Mary adds up her non-direct costs. These are costs she incurs that aren't related to sales. Petals' costs included marketing, rent, and salaries to her 2 store managers. These costs are known as selling, general, and administrative costs, or SG&As, and are often thought of as the company's overhead. Gross income minus SG&As is referred to as operating income, or income earned from a company's operations. Lastly, Mary subtracts taxes from her operating income to get her net income. Mary now has a good understanding of the profit generated from Petals. Usually, income statements are a little more complex to put together and are handled by professional accountants, controllers, or CFOs, and follow the general accepted accounting principles. To learn more about income statements and other topics, head over to WallStreetSurvivor.com.
All right, welcome back. The income statement is perhaps one of the key financial statements that we need to understand, and a lot of the forecasts that we do for our companies are based around the line items in the income statement. So the first one at the very top is the revenues, and the revenues or the sales are how much this company is generating in terms of gross sales. We calculate sales by the amount of products it sells multiplied by the price that it sells that item. So sales, we can see this either growing or declining over time. The next item is the cost of goods sold. Now the cost of goods sold is the cost that it takes to sell those items. So if we're Apple in this example, the sales are the total amount of gross revenues that they get from selling, let's say, computers and iPhones. But the cost of goods sold is the total cost of all the components that they took to put that together to sell those items. After that, we are left with the gross profit. So how much do we sell it for? $100. How much did it cost? $80. The gross profit is $20 in that device. And then we would multiply that by how many devices that we sold. After gross profit, we have a couple of expense items. So we have, in this case, research and development costs. That's how much Apple is paying its research and development team to continue to innovate new products. We have operating expenses, which can include normal personnel expenses, general and administrative expenses. These are your headquarters costs and your headquarter employee costs. We also have your marketing costs. So all of your individual expense line items come there below gross profit until we're left with operating profit. Your operating profit is your profit after all of your normal business expenses. This may be referred to as EBIT in many financial news sites. Another item related to EBIT is EBITDA, and so you'll hear analysts talk about EBITDA. EBITDA is your operating income, your EBIT, added your depreciation costs. And the reason why you would add your depreciation costs is because this is a cost which is stretched out over time. And so EBITDA is often used as a proxy for how much cash earnings that business generated that year. Below EBIT, we have interest expense, and that's how much interest expense you pay on debt. You have income tax expense, that's how much tax you have to pay. And then finally, after all of our expenses, we're left with net profit. And these are our earnings, these are our profits, which we've talked about. And ideally, stocks follow earnings, and we want to invest in companies that have growing profits. This may be through growing revenues, but it also may be through growing profit margins. And below that, we look at earnings per share. So if you take the profit divided by the shares outstanding, then we're left with earnings per share. So I hope that explains one of the key financial statements, which is the income statement. And we have these key line items to understand. If you have any questions, research it at Investopedia or other websites. Thanks so much.